Hello and welcome to the Of Interest podcast. I'm Dan Brunskill from interest.co.nz. The Reserve Bank of New Zealand just delivered its 11th consecutive rate hike, surprising almost everyone with a 50 basis point lift that took the official cash rate to 5.25. This means interest rates have now increased 500 basis points since August 2021. That's a massive shock to the economy, to households and to businesses. This episode will take a closer look at how those higher rates are impacting businesses specifically. Our guest is Christina Leung, the principal economist at the New Zealand Institute of Economic Research, which just this week released its quarterly survey of business opinion. I started by asking Christina why economists had underestimated the Reserve Bank's most recent rate hike.
A lot of it comes down to interpretation. At the end of the day, forecasting is an art, not a science. And then when it also comes down to a lot of it is just the degree of comfort that the Reserve Bank has that it is bringing inflation, that it will bring inflation back towards its 1 to 3% target band over the medium term. Now, of course, all these things are very open to interpretation. For the Reserve Bank, it's placed a lot of focus on longer term inflation expectations. And the fact that those, if you look at their survey of expectations, the 2-year inflation expectations measure, that still remains outside of their 1 to 3% target band. So for the Reserve Bank, they're very mindful, not wanting to spark that wage price spiral in which you see that permanent change in wage and price setting behaviour. For example, house workers demanding high wages to cover for the fact that in anticipation of high prices down the track. And then also for businesses putting up prices just because they're expecting that costs, for example, will be high down the track and wanting to make sure that they're covering their costs over the coming year. So what you then tend to see is that it becomes, those expectations turn into a self-fulfilling prophecy. And that's when you get the risk that high inflation becomes entrenched in the New Zealand economy.
Mm-hmm. Okay, so maybe economists are looking a little bit at economic data and indicators and slightly less worried about inflation expectations, but the Reserve Bank is putting a little more weight on inflation expectations than perhaps people are factoring in sometimes.
Yeah, or more just the fact that because we're forecasting with a quite degree of forward-looking aspect to it, there's a lot of uncertainty over how that will track over the coming years. And for the Reserve Bank, they're keen to ensure that they don't get behind the curve and have inflation high inflation become entrenched, which then makes it that much harder for them to bring it back down towards the 1 to 3% target band.
Okay. When we talk about monetary policy in New Zealand, we almost always talk about mortgage rates and households because this is New Zealand and owning a home is a sort of religion here. But we were quite keen on this podcast to get you on and talk about how high interest rates are affecting businesses. And your organisation has been surveying them for, I think over 60 years. Can you tell us a little bit about the quarterly survey of business opinion? How did it start? What is it? And what does it aim to discover?
Yeah, so our quarterly survey of business opinion has been running since in the 1960s. So it's the world's second longest running business survey. And then also progressively, we've had more measures added to that survey. So what it does is survey businesses across the key sectors of manufacturing, building, retail and services. And then also we survey architects just to provide that an indication of the pipeline of construction work. So across these sectors, what it provides is then how businesses are feeling, what they're seeing in regards to demand in their own business, what they've been doing with hiring, what they're seeing when it comes to where are the pressures that they're seeing, whether it's costs, labour shortages, materials, as we saw with over the COVID pandemic period, we had the global supply chain disruptions really impacting on material shortages, and then also what they're thinking over the next quarter and then the months ahead beyond that as well. So then what happens, what that then does is provide us a pretty good gauge in terms of what's going on, what's going to happen when it comes to employment, inflation indicators, and then also with investment as well. So it allows us to get a sense of where the pressures are are and which sectors particularly are feeling the pressure, which sectors are doing relatively well, and then what businesses are thinking for the year ahead as well.
So if you had to give a 1 or 2 or 3 sentence summary of the most recent survey, what would it be?
So in terms of what we're seeing in the March quarter, certainly we're seeing that while there's been a bit of a pickup in business confidence from the record low levels that we saw in December quarter of last year, overall businesses are still feeling pretty downbeat, and their expectations are that it's going to be a fairly soft demand outlook ahead. Cost pressures, when it comes to inflation, it's a bit of a mixed picture. Some sectors, such as the manufacturing and the services sector, are reporting a decline in costs, but then some other sectors, such as the retail sector and building sector, are continuing to report intense cost pressures. So a bit mixed there. And so overall, I would couch it as it's still an environment where inflation is still quite elevated. Overall, what we're also seeing is that even though there has been some improvement in confidence, when it comes to the fact that you're seeing signs of that slowing in the economy gaining traction, there is still that degree of caution there. That said, though, businesses are looking ahead, looking at hiring again, and then also when it comes to investment, there is a bit less caution in regards to investment in plant and machinery and buildings. So what you tend to see over the history of the survey is that in times of uncertainty, that tends to get businesses a lot more cautious about hiring and investment. So conversely, the fact that you're seeing businesses feeling more positive about hiring and investment, it does suggest that even though businesses are expecting softening demand outlook ahead, there's a bit less uncertainty, so that they're feeling that they can plan around the softening in activity ahead.
But those improvements in the survey, they're from one of the worst levels ever, is that correct?
Yeah, so if you look at confidence, that was at record low levels back in the December quarter of last year, and we're seeing some pickup in confidence from that. Also, when it comes to activity in their own business, while a net 10% of businesses report a decline in activity in their own business, that is a pickup from the previous quarter as well. One of the interesting things to note from this quarter also is the fact that when we asked businesses what the primary constraint on their business was, that shifted from labour shortages being a top primary concern amongst businesses. We saw labour shortages becoming increasingly acute over that COVID pandemic period. But now in the March quarter, we've had sales overtake finding labour as the top primary constraint for businesses. So what that suggests is that you're seeing an environment where it's shifting away from capacity pressures towards now demand, that slowing in demand being more of a key concern for businesses.
That's the part of the survey I found most interesting. I think the survey said it was the first time since sort of mid-2021 that businesses were more concerned about making sales than finding staff to actually sort of deliver or produce the products they're selling. And that seemed to me like a sign that interest rates were really slowing demand. Is that how you interpret that?
From the survey, it would suggest that you're seeing those signs that higher interest rates are having that intended impact of dampening demand. And with that, you're seeing that ease in capacity pressures. Also, with the reopening of the international borders, that's allowed a lot of firms to bring in workers from overseas, and that's helped to alleviate labour shortages as well. So overall, you're getting this environment where demand is slowing. You're a bit more supply coming on board from the reopening of international borders, and also that the supply chain disruptions being resolved over more recently. So with that easing in capacity pressures, it would suggest that would flow through to reduce inflation down the track.
Because that's what the Reserve Bank's trying to do here, isn't it? It's trying to bring demand down to the level the economy can actually meet with its supply. And the biggest constraint, and it sounds like it's changing, but the biggest constraint has been materials and staff. You just can't get enough people and enough things to make into stuff to sell. It sounds like the problem is changing, and the problem is becoming there's not enough people buying your stuff. That seems like a big step change.
That's right. So, yeah, the fact that you're seeing now more that reduced demand being more of a dominant factor in the New Zealand economy, when for so long we've had businesses talking about labour shortages being really hampering their business, that seems to be less of concern now. This is would be what the latest survey suggests.
That seems like good news. Talk to me about sort of the we call the transmission of monetary policy, or how higher interest rates sort of arrive in the economy when it comes to businesses? Because we hear in households there's quite a lag because mortgages are set on fixed term rates, and it might take a year, it might take 2, it might take 3 to pass through. How does it work with businesses? Are they more linked to floating rates? How do higher rates first hit businesses?
Naturally, OCR will flow through to borrowing costs for businesses as well. In regards to which rate they would be facing, that would really depend on whether they're borrowing at the retail, the business rate, or a lot of small businesses are actually borrowing on their house as well, for example. Also, mortgage rates would still have an impact on many, particularly the smaller businesses. More indirectly, what you do tend to see as well is that with high interest rates, you are going to see, as we often talk about, the fact that with many households facing significantly higher mortgage repayments and reining in their spending as a result of that, what that means on the flip side is that for businesses, they're going to see reduced demand for their products and services. So that in turn, there are two channels in the sense that they face higher borrowing costs as well, but also they're going to likely see reduced demand as households rein in their spending. That's where a lot of that that's when you see that transmission of interest rates go through to the broader economy. Also, you to the extent that now, particularly in this environment where we have our central bank indicating a high interest rate outlook relative to other major economies. Now, that would likely increase demand for our New Zealand dollar. So with that high New Zealand dollar, what you tend to see is that it makes our exports less competitive, and then also it makes imports cheaper. So again, yes, it would help to make the price of imported household goods cheaper and help with bringing inflation down. But it does mean that for exporters, it's a reduction in New Zealand dollar denominated income.
Okay, so there's kind of 3 effects. Your borrowing costs go up. Eventually, there are less money for consumers to spend on your products, and potentially your exports become less competitive. Those are kind of the 3 main impacts of interest rates going up.
That's right.
You talked about business. Lots of people do borrow against the house, the smaller businesses. When you are doing business borrowing, are those rates more attached to floating rates than household borrowing are?
It varies and probably depends on the assessed riskiness of the business by the banks. But I would say generally to the extent that there's a perceived greater risk attached to lending to businesses relative to having the collateral of a house attached to it, you're likely to see higher rates as a result of that.
Another thing I found interesting in the survey, the most recent one, is the metrics about profitability, which it sort of, your survey showed profitability declining. Can you talk a little bit about how well businesses are faring in terms of just how much money they're making?
Yeah, so it's an interesting one. And what we've been seeing, particularly over more recently as where inflation has surged, is that businesses have been reporting that cost pressures have become more and more intense. Now, prior to this strong demand, given we've had that unprecedented amount of stimulus injected into New Zealand economy, has allowed businesses to with varying degrees of success, pass these higher costs on to customers by raising prices. More recently, though, while there has been some easing in cost pressures reported by some sectors, overall, what it also means is that with that weakening in demand, it means that there's less likely to be less pricing power for a lot of businesses. So even those that are facing higher costs, they're likely to find it more difficult to be able to pass these on to customers by raising prices.
Okay. So as inflation has gone up and as interest rates have gone up, have we seen business profitability go down?
At the moment, that looks to be the case. The fact that with that softening in demand, businesses are that reduced pricing power, but with cost pressures still not moderating enough for them to recoup margin, you are in this environment where its operating margins are still quite crunched in.
Okay, that's interesting to hear because, in the political realm, there's quite a lot of blame and finger pointing over inflation, who's responsible for it, and different people to point to different parties. But one potential scapegoat, you might even say, is sort of businesses that are making excessive or opportunistic profits. But it sounds like your survey says that's not the case. Do you feel confident saying that sort of business profits are not responsible for inflation, or is that too far?
So our survey tends to show things at a macro level. Certainly, I'm sure within certain sectors or even businesses, there will be ones that feel they are able to take advantage and increase prices and bolster their margins more than some others. Overall, it would depend on the competitiveness of that particular industry that they're operating in. If there were a lot of other competitors out there, then you would tend to see that the pricing power that they have would be a lot lower, in which case it would be a lot harder for them to be putting up prices because there are alternatives for customers to be switching to.
Okay, so in an aggregate macro level, there is not a lot of opportunistic profits going on. Actually, business profitability is going down, but there might be some specific examples, and perhaps listeners could imagine one or two that have pretty significant pricing power, perhaps due to a semi-monopoly type scenario.
That's right. If there was a lack of healthy competition within certain industries, then you would tend to see probably more opportunistic pricing behaviour take place.
Pivoting back to the survey and the sort of the macro view, asking questions about investment and hiring intentions, you said they've gotten better, but from a very, very, very low base. When you look at the results of the survey, does it suggest to you that New Zealand is heading into a recession? And if so, how bad might it be?
Certainly, it suggests slowing in activity. What we saw in the December quarter was a contraction in economic activity. Now, March, it's going to be a lot more, a lot of uncertainty over the net impact of those severe weather events that we saw early part of this year, to the extent of whether we know that there was a lot of destruction of property, crops, and livestock. And overall disruptions to transport activity. So from that, you would expect to see a decline in economic activity. But on the flip side, there have been a lot of repair and recovery activity take place too. So for the March quarter, there's uncertainty over what that net impact will be. Certainly, we wouldn't be surprised if there was to be another contraction in economic activity for the March quarter, in which case then that would fit the definition that most often use of being 2 consecutive quarters of economic contraction for that to be a recession. In terms of how deep or how much of a recession we'll get, like how much of an impact, I would say a large part of it would depend on how high the Reserve Bank choose to take interest rates. Certainly, the higher it takes interest rates, then the more likely you're going to have weak economic activity becoming more prolonged in the economy.
Mm-hmm. I sometimes struggle to think and talk about New Zealand entering a recession, because I think what people think about is some of the very bad recessions we've had, perhaps 2008 or some previous situations that have been pretty rough and people have some traumatic memories from. When we talk about a recession this time around, are we talking about anything like that, or is it could it feel very different? The recessions come in different shapes and sizes, and you sort of say recession and everyone has some sort of traumatic memory in their head. Is that image right, or could it be very different? Is every recession different?
Of course, there's always that discussion about the profile of what we're facing over the coming years: a V-shaped, U-shaped, L-shaped, K-shaped. So in terms of overall, we're still seeing the New Zealand economy is pretty resilient. So while we're seeing that slowing in economic activity, you do tend to see that a lot of businesses are able to pivot to new opportunities. And then also on the flip side, when it comes to that buffer and how able both the government and the Reserve Bank are to respond to the changing circumstances. Like, for example, the fact that we saw at the start of the COVID pandemic that the Reserve Bank and the government rushed in with that stimulus. What that shows is that like policymakers generally are quite quick to respond if necessary to any severe downturn in activity, potential downturn in activity. So that would suggest that overall we are likely to see more of a shallow recession if we were to get one.
If things get bad, the Reserve Bank has plenty of headroom to cut rates again and stimulate the economy, get things moving again.
Yeah, so to the extent that it's increased interest rates so much, if we were to see some severe downturn ahead, that does provide room for them to cut rates down the track. We're not in this environment where we're hitting the zero bound of interest rates, where like the flip side of that, we're hitting the zero bound and it becomes a lot harder to keep stimulating the economy because you've hit that lower bound. Like what we're in is an environment where, because interest rates have increased so much, if there was to be any downturn in activity, then it could easily reverse those interest rate increases to provide stimulus for the economy.
One thing I found interesting about the sort of the survey and the RBNZ's sort of coming out the same 2 days apart or whatever, was that one of the things the Reserve Bank pointed to as being a reason for the bigger rate hike is the rebuild from the cyclone and I guess Auckland flooding as well, which strikes me as something that would, the economic boost would occur in the construction sector. But in your survey, the construction sector was one of the most downbeat sectors. What do you make of that mismatch? Do you think RBNZ has got that wrong, or has the construction sector got that wrong, or is there something else entirely happening?
I guess the rebuild will only impact on particular regions. And then overall, even with the rebuild, we are still looking at a profile of construction activity declining, but from high levels, from current high levels. So while the rebuild will help contribute to construction demand, we are still in an environment where overall construction demand will be falling off from these current high levels. So for construction sector firms, they are still bracing themselves for weaker demand ahead.
Despite a little bit of a boost from the rebuild, it's just not enough to offset the decline.
That's right. So you can think of it as that over the coming years, you're going to see that decline in construction activity not quite as steep as it would have been in the absence of rebuild activity. And
to sort of carry us out, talking about economics in this era can be quite depressing. It can be quite gloomy. Do you have any good news for us? Was there any good news in this survey? Do you have a little empowering or optimistic message that we can finish on? What's the good economic news out there?
I know, often it's easy to focus on the bad news. I would say if it came to it, we've fared generally, I mean, in hindsight, one could argue that we overstimulated the economy, but generally the New Zealand economy has fared pretty well out of the COVID-19 pandemic. And what it's shown is that businesses are generally able to pivot to new opportunities. It's helped to accelerate digitalization, which, while there, of course, are some unintended consequences in terms of who might be left behind, overall, you are seeing that it means that people are finding ways of working better and being able to access new markets and think about how they can do things differently. Also, when it comes to workers, the flexibility that comes with that whole working from home, more able to do so. So overall, I would say it's improved the flexibility for households and businesses, which would be, I would say, a positive that's come out of this COVID-19 pandemic, making households and businesses think about how they can do things better.
Okay, I'll take that. Christina, thank you so much for coming on the podcast. It was great to talk to you.
Kia ora. Thanks for having me on your show.
That was Christina Leung, the Principal Economist at the New Zealand Institute of Economic Research. I'm Dan Brunskill from interest.co.nz. Thank you for listening to another episode of the Of Interest podcast. See you next time.